No change. The Federal Reserve holding rates steady in the range of 3.5 to 3.75%. Now, this was a split decision. Federal Reserve Governors Stephen Miron and Chris Waller both dissenting, preferring to cut rates by 0.25 percentage point. Waller had indicated ahead of the meeting that he still has concerns about the health of the job market. Now, Fed officials upgraded their assessment of the economy to solid from moderate on the back of that strong third quarter GDP reading expectations for a strong fourth quarter as well. They see inflation as, quote, somewhat elevated, and said the job market is showing, quote, some signs of stabilization. Notably, they dropped language from their statement that said that downside risks to employment rose in recent months. The statement simply reading now that the committee is attentive to risks to both sides of its dual mandate. Now, when it comes to the path for future cuts, officials reiterated in their statement that, quote, in considering the extent and timing of additional adjustments, they will be attentive to incoming data, the evolving outlook, and the balance of risks. Back to you.
Jennifer, just want to follow up with you here. Two interesting things in my view. One, that Miron dissented in favor of a 25 basis point cut. He's not arguing for another bigger cut. And that Waller joined that dissent, which is especially interesting given the backdrop that President Trump has still not made his decision of who's going to be his nominee for next chair of the Federal Reserve.
Julie, I am so glad that you brought that up, because I was literally in the lockup looking at who voted in favor for this decision and who voted against. And I thought it was very telling, to your point, that Chris Waller dissented because he is still on the short list for Fed chair. But you know who didn't dissent? Michelle Bowman. And she gave a speech 2 weeks ago that seemed to lay the case for a clear-cut rate cut. And the fact that she did not dissent, it was also telling she's not on that short list anymore. And we know that Governor Steve Miron thinks that they should move faster to where he sees neutral. He sees neutral a lot lower than where rates are right now. The fact that he feels like they could slow down a little bit at this point is also interesting. Maybe that speaks to the strength and the pickup that we've been seeing in the economy. The fact that officials have upgraded their assessment for the economy. They say now economic conditions are solid. They're not moderate. They've also upgraded the outlook for the job market, which is why they cut 3 times last year, right? They took out those insurance cuts. Now they see signs of stabilization. Hey there, Josh. Fed Chair Jay Powell saying that the Fed is well positioned here, that policy is in a good place, signaling that the Fed is content to hold for right now, in no rush to cut rates. He said there was broad consensus on the committee to hold rates steady today, of course, despite those two dissenters. As for what it will take for the Fed to cut rates, take a listen to what Chair Powell had to say.
We're not trying to articulate a test for when to next cut or whether to cut at the next meeting. What we're saying is we're well positioned as we make decisions meeting by meeting, looking at the incoming data, evolving outlook, and all that. And we're in a position where we still have some tension between employment and inflation, but it's less than it was.
Chair Powell would not comment on the Department of Justice investigation into his testimony on Capitol Hill, nor would he offer any comments on whether he will stay on as a Federal Reserve governor after his term as chair expires in May, though he did offer an explanation as to why he opted to attend the oral arguments for Fed Governor Lisa Cook at the Supreme Court last Wednesday.
I would say that case is perhaps the most important legal case in the Fed's 113-year history. And as I thought about it, I thought it might be hard to explain why I didn't attend. In addition, Paul Volcker went to a Supreme Court case famously in, I guess, 1985 or so. So it's precedented, and I thought it was an appropriate thing, and I did it.
As for Fed independence, Chair Powell says he is confident that can be maintained, and he is committed to doing so. When asked what advice he may have for whoever succeeds him as Fed chair, he said, don't get involved in elected politics. Just don't do it, and curry favor with both sides of the aisle in Congress. Josh.
Wise advice there, Jen. I really like, Jen, actually, your question in the presser, because it's one that's been asked so many times on this show to different economists and strategists. Was you were asking him, Jen, about that interesting divide between the solid growth and the cooling labor market, right? What did you make of his answer there?
Yeah, he says if it's a fight between GDP and the labor market, it's generally the labor market that wins. He says that data is generally more reliable. He says GDP can be difficult to parse. And if that is the case, obviously we've seen much weaker payroll numbers. We know that a lot of structural issues are driving the job market now with lower immigration, but we also know there are some cyclical issues there. So if that is the case, that would be more of a case to cut rates further this year. Of course, we'll need to see if GDP does indeed pop up, if that fosters greater demand for labor. But it sounds like based on what we've seen so far, we're not going to see that anytime soon.
Let's get some more reaction now to the Fed's decision to hold interest rates steady. Joining now, we have Loretta Mester, former president of the Cleveland Federal Reserve and adjunct professor of finance at the University of Pennsylvania Wharton School. Loretta, great to see you. So we got the decision, Loretta. They're holding rates steady. One, what do you make of the decision? And two, Loretta, when do you think cuts could resume?
Well, I think it was the right decision. I agree. There's no rationale for cutting at this point. They had already brought the funds rate down 75 basis points. So that, was their insurance against the softening in the labor market. And as they pointed out in the statement, the unemployment rate has stabilized a bit in the, recently. So that's on the labor side. They're still going to be watching that because there's still, dual-sided risks. They also said that in the statement. The inflation side, they have to watch that too, because inflation has been above 2% for over 5 years. They haven't gotten it back. There's reason to believe firms are telling us that they're planning to pass on some more of the tariffs this year. They've avoided it probably as long as they can, some of the firms, and so they're going to be passing them on. So the inflation numbers, they're still going to have to see how the tariffs play out, and hopefully if their story of how they're seeing the tariffs plays out, they'll get to see goods prices to begin to fall again, and then they'll get inflation on that downward path. But there's no reason or compelling reason now to take another move down in the interest rate. In fact, there's reasons to think that there's some tailwinds to growth going into the beginning of the year with the tax cuts. People are going to get bigger refunds, so they're going to feel that they have more money to spend, and businesses will get that depreciation, the full expensing, so they're going to feel that they also can. The one tailwind, though, is the continued uncertainty that is plaguing this economy, and partly because of what's going on geopolitically, our own policies not sort of settling down. And so that's something that I think could affect the economy going forward. But all signs suggest that the economy is in a good place now to really watch and wait.
So, Loretta, it's Julie here. So what do you think, what are you going to be most closely watching to look for a sign of change, to say either, okay, we feel more comfortable, we can start to cut more, or more worried? I mean, is it more the labor market? Is it inflation? And do you think the Fed's been doing a good enough job at articulating that challenge?
Yeah, I would love to see the FOMC do a better job of really laying out what their rationale is for their policy decisions. And that means talking about what their outlook is, what the risks to that outlook are, but also then using that to sort of explain. And if we see, for example, the labor market deteriorate in a material way, then we're prepared to use our policy tool again. And I think that'll be the catalyst for the next cut. It'll have to be something, I think, in the labor market, or more confidence that the labor market is really stabilized and inflation is on that downward path. But they're already very near or close to neutral, I think. So they don't have that much further to go to neutral. I think if they were to articulate that rationale more fully, I think it actually is a good thing in terms of preserving Fed independence, because then the next chair that comes in will really have to articulate in a similar way what their policy view is. And I think that's a better way of preserving that independence and making sure that the Fed's making policy decisions based on the right data, economic analysis, and not being driven by politics. And I think whoever becomes chair, they're going to have to really show that they're doing policy in a credible way. There's going to be some skepticism around whoever becomes chair. And building credibility means laying out the case. And if the previous chair and FOMC have laid out a case, the new chair is going to have to do more than just say, I read the data differently, and so therefore I want a different policy. They'll have to really articulate a rationale that may perhaps differs from the previous rationale, but they'll have to address it. And I think that's something I'd like to see the Fed doing in the final meetings with Chair Powell, is to really lay out their rationale for how they've been setting policy and why their policy is appropriate.
Loretta, on that point you're making there, Nick Timmeros over at the Journal has a piece out. Here's what he writes. He says, Trump wants something that may not exist. A new chair who will pursue his demands for lower interest rates while still commanding enough credibility on Wall Street and from his colleagues to deliver them. What do you make of that, Loretta?
Well, I think, the president, it's his right to say kind of what his policy views are. I think what's been very unhealthy here is the vitriol and the challenges and the really blatant attacks against the Fed policy, which undermines the public's credibility with the institution. So it's basically trying to tear down the institution rather than really having an adult conversation about my preferred policy path would be this, and the Fed isn't doing it. So already the new chair who comes in is in a very difficult position, because I think Nick is right. That person coming in will need to build their credibility with the markets, but also the general public as well. And every time the president goes out and attacks the Fed, right, it raises questions. Even if the Fed's doing exactly what they're supposed to be doing, which is basing their decisions on the economic situation and really setting policy, only caring about achievement of the dual mandate goals that they've been charged with achieving. The fact that this question has been raised makes it that much harder for the Fed to actually do its job and do it well. So again, we're in a situation now where you can't wind that back. But hopefully the new chair comes in, they will be held to account in terms of having to really articulate a really credible case for whatever policy decisions they want to make, because they're going to have to bring the committee along with them. And I think anybody in that job is going to take the job very seriously. And part of that is knowing that, the U.S. economy really depends on sound Fed policy. And frankly, the world's economy also depends on the Fed setting sound policy. So I guess I would think that any chair coming in would feel that weight, and that would dominate over these external forces that are trying to get policy to move in a particular way. You can have different views. If the new chair comes in, they may have different views than the current chair. But as long as they're really articulating a credible economic case, then I think they'll be able to get the consensus of the committee to go along with that. And then if the case isn't credible, or if the policy turns out not to be the right policy, then the Fed will have to go in a different direction, because they're going to be focused on those dual mandate goals. Maybe that's naive of me to say, but I do think the weight of that job and the importance of it will weigh in a positive direction for whoever comes in as chair.
So this sort of back and forth is continuing between Trump and Powell, even if it wasn't vocally from Powell at the press conference. Anything in terms of because this has become, I don't know, not that we've gotten used to it, but it keeps happening. Is there an economic or markets effect that we need to be watching as a result of all of this?
I don't think so. What you saw was Powell, who is a Fed chair who has 2 meetings left after that one. So he was trying to avoid all of the questions about policy, and the great clip that you guys just showed earlier highlighted that quite well. But he's trying to stay out of it. It now seems that they are fairly comfortable with the growth outlook in the U.S. economy, in which case it's largely pretty clear that the last cut that we got last year was the last one from the Powell-led Fed. So he is trying to kind of just stay clear of that. Trump's not going to convince him otherwise, especially given they explicitly said the growth projections are better than what they had penciled in December, in which case it kind of doesn't really matter for the next couple meetings. Really what's going to be important, or at least what could potentially move markets from here, is what happens with the Fed chair race and how odds kind of shift in the next couple of weeks.
So I want to ask you about that, but before we get to that, because I think it's consensus now that sort of Powell is done cutting in his tenure, the Powell-led Fed. Do you think that data will continue? Do you think that they did the right thing yesterday? And do you think that data will continue to support the argument to not cut for the next few meetings?
Yes, the data is fairly firm. It started to pick up. The labor market data is stable, if not, in our view, looking forward, set to actually inflect a bit higher. Growth continues to surprise to the upside. Inflation is a bit sticky. There's not a great reason, and certainly no rush, for them to be cutting at this point. Now they're closer to neutral, if not at it. And as Powell noted, maybe they're on the top end of what their estimates are for neutral, but there's not really an urgency at this point, especially since fiscal policy is going to start to become fairly accommodative in the next couple of months as the stimulus checks from One Big Beautiful Bill start to hit and flow into the economy. So there's very little reason for the Fed to be cutting at this point. Perhaps later this year, under a new Fed chair, is when they might be able to deliver a few more cuts.
All right, so let's get to that next Fed chair. Our Jennifer Schonberger, our Fed correspondent, yesterday spoke to Scott Bessent, of course, the Treasury Secretary, and she asked him when we might find out. This is what he said.
In terms of Fed search, we got some great candidates. I was talking to the president about what he's thinking on the plane back from Iowa last night, and my inclination is we may hear something in the next week or so.
I feel like it's been in the next week or so for a while, but maybe it actually is in the next week or so at this point, according to the Treasury Secretary. So Rick Reeder is still in number one spot on Polymarket with 38%, but Christopher Waller, after his dissent yesterday, moved higher. At this point, what do you think, Stephanie?
Yeah, I think it's kind of anyone's game at this point. I would say the most likely options are Rick Reeder, Kevin Hassett, Kevin Warsh. Of course, Waller did rise after the dissent, although I don't think he has incredibly high odds. We also have to talk about the possibility that Trump just names Bessent and then he has to resume and then he ends up taking the seat, although that's certainly not my base case. But Trump isn't particularly happy with any of the candidates across all of the main things that he's looking for. He wants somebody who's going to be loyal, who's going to have market credibility, and also incredibly dovish. And none of the candidates on the list really fit the bill. So I don't think his mind has been made up yet. So it's probably going to drag on for a little bit longer. And I wouldn't expect that we'll hear for an announcement in the next week.
And Stephanie, aside from what's going on here, something that has been affecting the Treasury market here has been what's going on in Japan, where we have been seeing a surging Japanese yen, a falling U.S. dollar. That has repercussions for the U.S. Treasury market also. How do you think that continues to play out? Because that also sort of complicates the president's quest for lower rates.
Yeah, it's a tough one. And of course, the president earlier this week came out and said he was very comfortable with the dollar. He commented on how it kind of moves like a yo-yo. And then that certainly led to further dollar weakness, in which case Bessent had to come out and make it clear that the U.S. had not intervened in dollar yen. It is certainly a complicated dynamic. I think we're at a period of time where we can't really see much further dollar weakness before it becomes a problem for broader markets. The real risk is the yen carry trade, in which people short the yen and then invest elsewhere. The moves in the yen kind of complicate that trade. So the real risk is that it becomes a broader risk asset problem. And they have to really be careful about that. Our best guess is that as we move through the next couple of months and you get better economic data, that will just naturally support the dollar. But that would require some more sort of stabilization out of policies from the administration.
President Trump has tapped Kevin Warsh to lead the Federal Reserve, ending months of speculation over who would succeed Chair Jerome Powell. Warsh is a former Fed governor. He aligned himself with Trump last year by publicly calling for lower rates, despite being a longtime hawk. Joining us now, Ed Yardeni, Yardeni Research President, and of course, Warsh was also considered to be head of the Fed when Powell ultimately got the job, Ed.
Right.
So what do you think of this pick? What do you think the markets think of this pick? And what kind of Fed chair ultimately is Kevin Warsh going to be?
Well, he definitely has a great resume, without a doubt. He is a pragmatist, as you mentioned. He has had some experience of being a hawk. Now he seems to be a dove. But I think he's going to be flexible. I think it's actually kind of fascinating that we got a fairly solid citizen here as a nominee. It kind of makes you wonder whether we needed all the drama that came with it. Of course, it's not a sure thing that he's going to get through Congress, but I think he will, as long as the administration signals that they're going to back off on attacking Jerome Powell. Let him move on and let Warsh come in.
We'll see if that happens, Ed. I mean, listen, we certainly didn't need all the drama, but the guy in charge, he likes drama, Ed. So
he likes drama.
So I think that's what we can expect going forward. You know, I'm curious when you talk about Warsh's resume. I know that he has come under some criticism by some folks around his commentary around the great financial crisis, when he thought that the Fed should not be as stimulative necessarily with its balance sheet. Is there anything we can sort of say, draw any lessons we can look at from that time to now?
Well, I think most economists would agree that QE1 was a necessary injection of liquidity. The question about QE2, QE3 is very controversial. I agree with the position that we only needed that liquidity round, and the rest was not necessary. And zero interest rates were also an extreme abnormality back then. But that we all learn from our jobs, learning by doing. I suspect he's had a lot of that.
Yes, very fair point, Ed. Now, as you pointed out, we've heard some murmurings that Tom Tillis might try to hold up this nomination unless and until the criminal charges against Jay Powell are dropped.
Right.
Any market implications if this gets held up for a significant period?
Yeah, I don't think it's going to get held up, because I think the administration is going to back off on attacking Powell. There's no benefits in doing that. Powell's only mistake was that he didn't bring the project manager and an engineer when questions were asked about the renovation of the Fed. He clearly was out of his depth, and he just should have said, "I really don't know anything about that. I'll send you a letter." Right. So they got him on a picayune charge, quite honestly, and I think this too shall pass. Look, the administration's takes a tough, dramatic stand, as we just agreed, and then they kind of back off. They've done that on Greenland. They seem to be doing that maybe in Minneapolis. It looks like we're going to get a avoided government shutdown, and now we know who the Fed chair is. So there's a lot of uncertainties that actually are behind us.
Yeah, thank goodness. I'm also curious if you think that this Warsh pick makes it more or less likely that Powell will stay on the committee, even if he is no longer chair.
Well, I'll quote the Fed Chair Powell. I have nothing for you on that. Who knows? If I was him, I'd say, enough's enough. Let's go fishing or play with the grandchildren.
Yeah, according to recent reports, that is his strong inclination, unless he feels like he has to stay.
He doesn't really.
Yeah, who could blame him, really, Ed? As for that confirmation hearing, when it does happen, what do you think the most important questions for Warsh are?
Well, I think Congress is going to dig deep into his loyalty to Trump. To what extent will he be independent of Trump? He should be completely independent of Trump, but clearly Trump has made it an issue. The problem for anybody who was going to be Fed chair is it's kind of the position got tainted by the politicization of the whole subject. So I think there's going to be a lot of questions on his independence. And does he agree that the Fed funds rate should be down to 1%? And I don't know how he's going to dance around that one, because that's what Trump's been saying he wants. And there's no way that other Fed voters agree with that.
Speaking of other Fed voters, Christopher Waller was out with a statement this morning explaining his dissent, which was quite interesting. Among other things, he said last year's data will be revised downward soon to likely show that there was virtually no growth in payroll employment in 2025, zero, zip, nada. And he said, let this sink in for a moment, zero job growth versus an average of almost 2 million for the 10 years prior to 2025. He says this does not remotely look like a healthy labor market. Do you agree, Ed?
Well, I think there's a lot of moving parts to explain what's going on here. And I'm not quite sure. I'm relatively sure that lowering interest rates isn't going to fix the labor market. There's issues with lots of kids coming out of school with student loans and with degrees that are very ambiguous about what their skills actually are. I think there's a huge mismatch between what the economy needs. So let's face it, we need a lot of plumbers and we need a lot of roofers and people in basic trades, and that's not what's coming out of college.
So what do you think? What do you think we fix? How do we fix that? How do you fix that labor mismatch?
I think time will fix it. This is a major technological change that's going on in our economy right now, and it takes a while for people to kind of figure it out and reinvent themselves. I think we're seeing part of the fix in new business applications. They rose to 5 million, all-time record high of 5 million last year. I think a lot of people are saying, the heck with it. I'm not going to bother sending another round of 300 resumes. I'm just going to see if I can raise some money from the family or a bank or a credit card, and I'm going to start my own business.
And Ed, you talked about all of the sort of like lingering uncertainties that we had at the beginning of this year, some of which are now seeming to be resolved. I know that you're looking for gains in stocks this year. Yeah. Anything that's happened thus far that has shaken you from that conviction, including the earnings we've seen so far?
No, I think the earnings outlook is great. The analysts thought it would be up 8% year over year coming into the fourth quarter. I think the numbers are going to be more like 10 to 12%. We've had really 3 quarters in a row now where earnings have been a lot better. We're going to have record earnings in the fourth quarter. I think that's pretty much a layup. We had record earnings in the third quarter, and earnings are really what drives the economy, in the sense that profitable companies expand. They increase their spending on capital. In the past, they used to increase their payrolls. And the initial unemployment claims data and the continuing claims data give me some hope here that just as we've all given up on job expansion, suddenly it'll occur again. Maybe all that's been going on here is companies froze hiring until they figured out what AI could and could not do, and they're going to conclude that it can't do everything.
Let's hope that that's the case, Ed. Thanks a lot. It's great to see you, as always.
My pleasure, Julie.
So we have this latest move in stocks coming as a result of tech, powering things to new highs. So how does that fit into the overall picture now?
So, I think what we're really seeing is this, what we've been calling ProSec, or this move to produce for security. So what do we need to produce for production for security and resiliency? So I think energy, electricity, that's a huge part of it. It fits nicely with the data center and AI, all these conversations about the investment, et cetera. Okay, who is going to power those? Where are we going to get that electricity? And at the same time that you have these massive demands from the data centers and AI for electricity, you've got the average person sitting there wondering what's going on with their electricity bill, right? All of a sudden, literally everyone I talk to, like, why is my electricity bill X more than last year? And you look at it, CPI, the component of electricity, it moved about 4% over 10 years, and it's moved 40% in the last 5 years. So all of a sudden, that's the key. So I think we're going to see massive amounts of electricity generation. I think it's going to be solar. I think it's going to be coal, gas, nuclear, all of those. I do not think wind's going to make it under the Trump agenda. He just hates wind too much, but I do think he is actually going to cave in on solar. So you want to own those. You want to own construction facilities. anything that's going to help this build out. And then the other flip side of it is chips. I think Intel is going to be a big play for this country. We, as a nation, own 10% of it. I think the president's going to do what he can to help Intel. They've got their own technology, and you're going to see the need. It's just so clear. We need to make chips domestically. We cannot rely on Taiwan to produce our chips when they have to ship them right by China. So those are kind of the barbell investment strategies to me. These rare earths, critical minerals, electricity, and then the chip industry.
And do you want to own that stuff instead of the hyperscalers and, some of the companies that are going to be, building the LLMs or putting them into companies?
For me, yes. And so one, Intel's been doing phenomenally well, right? I think it was up 80% last year, it was up 40% this year, settled off a bit after earnings. But they're going to make chips for this country, right? People are going to be forced or need to use their chips. On the electricity, you sit there and you look at these hyperscalers. One, they all trade at fairly high valuations. You see one down 8%, the other up 10%, so there's volatility. And to me, it's very unclear, right? It was all ChatGPT 2 years ago. ChatGPT, when I talk to people, is kind of, I don't know if it's anyone's top-ranked LLM right now. So who knows how this is all going to play out. So at this point, given valuations, I'd rather bet a little bit on the infrastructure than who's going to win.
And historically, Peter, you're a macro guy. So to take a step back for a moment, we're coming off of a Fed meeting where they didn't change rates, where really politics seemed to take more center stage than what's going on in the economy. So what does that backdrop look like? I mean, we don't seem to be out of the woods, at least according to the Fed, yet in terms of either inflation or the job market.
So one, I think the Fed is still a little bit hypersensitive to the fact that they missed and were all on team transitory. And again, if you were a corporation, someone would have got fired, lost their job. They're all still there. So I think that kind of weighs on them. When I look at it, I think the job situation is still a little bit murky. I don't like the job situation. I like looking at the JOLTS quit rate. To me, that's kind of a crowdsourced data. People quit if they think they can get another job. So I see weakness there. I think the Fed is overly concerned about inflation. When I look at something like a Trueflation, which seems to try and measure inflation a bit more real time, it's way lower. It's saying it's 1.5%. Now, it doesn't capture everything. The flip side of that is real estate. We still use, I think, it's owner's equivalent rent. And I can tell you, I think every year or two, I go through the BLS and try and figure out how to calculate owner's equivalent rent. I scratch my head. And yeah, maybe 50 years ago, people actually rented single-family homes. That's not how it works now. People rent apartments. You have Zillow rent. You have Cleveland Fed has a real-time rent. It's all come down. So we're still sitting there reacting to this overstating cost and shelter in CPI. I think the inflation story is fine. I think we can be sub 2.25%. That should let us cut. I think there's a decent chance Powell cuts once more before he's done. So he's got 2 meetings to do it.
I think you're an outlier on that there, Peter.
I am an outlier. And I guess my view is the data's kind of pushing that way. He actually did kind of point out that he might cut even if GDP growth was strong, if he's worried about jobs. I'm worried about jobs.
Right. He seemed to indicate, yes, that I thought that was a really interesting answer to a question about GDP versus jobs, sort of showing different things. And he seemed to indicate it's the jobs data that tends to be more of a real signal, typically.
Yep. And so I thought that was really important. Yeah. And the other thing is, I feel like, okay, so this month he stood up to the president and said, we're not going to cut, and we coalesced around no cuts. But I feel like, okay, you've won. He's got the moral high ground now. If the data shows, I think he's not going to be afraid to cut at one of the next 2 meetings. And no matter what happens, I think whoever comes in, whether it's Rick Reeder or someone else, we are going to be down 75 bips by September. We want this economy, the administration wants the economy running hot by that time. And I think there's also going to be a big fixation on 10-year yields. I think they're going to use the balance sheet in creative ways to keep longer dated yields lower. You just look at one of their stated goals. Besant talks about it all the time, and I listen to Besant probably more than anyone. They want mortgage rates lower. Well, you can do that by buying mortgages. That helps mortgage spreads, which is part of the equation. But mortgages price off the 10-year treasury. So if you get 10-year treasuries lower, that helps. So look for creative ways to get yields down. They can do things like Operation Twist, where they sell some of their shorter dated T-bills they own to buy longer dated bonds to help that. They can work in conjunction with the treasury. And that's the other thing. I think, everyone's been so fixated on, the Fed independence. I think we're missing that you can have a lot of cooperation between the admin, the Treasury, and the Fed, and it's still independent, but cooperation is a good thing. We've seen it in times of stress. We saw it during COVID.
Right, but but the two times you mentioned are times of emergency.
Yes, but
and for all 3 of them to coordinate, they have to be on the same page about that level of stimulus being necessary.
And I think you will see that as the new Fed chair takes over. Again, some of these things, that's so wonky. We all treat like this neutral rate as though it's some exact science. And I think even Yellen was once quoted saying it could be anywhere from 1% to 5%.
Right.
So there's a wide range. I think Moran's done a good job kind of attacking, saying the neutral rate's lower than we believe. So to me, 75 bips, again, I don't think we're going to get anything like President Trump wants. We're not going to be 1% Fed funds, but we can get to 2.875%, which would be 75 bips from here, I think pretty easily and justifiable.
What do you think about this idea that tariff inflation is still making its way through?
Yeah, I think it's slowly bleeding its way through. And again, I think that's kind of a steady state because, one, some of the exporters did cut their prices to give people a break. Well, they're going to slowly raise those prices. The tariffs keep coming. So I think you're seeing that. And when I look at everything I'm talking about, building out the electricity, building out the data centers, there's going to be construction costs going through this. There's going to be pressure. I'm getting a little bit concerned about commodity prices. I mean, they are skyrocketing. It went from gold and silver to now, if you dig it out of the ground, it's all of a sudden become very expensive. So that's my one fear that I didn't quite see until 2 weeks ago. I'm long a lot of these. I love uranium. I think uranium's going to do very well. I just don't see how we get to a 20, 30-year, 40-year energy plan without doing some sort of nuclear. So that's been kind of my big take in there. And again, I like companies like AES, some of the more solar-based companies that have been left behind, because I do think the President of Trump. And so when I look at uranium, that's a very high beta play and very risky. When I look at something like an AES or some of the utilities, much less beta, a little bit of a dividend, so you can play both of those.
All right, Peter, thanks so much.
Thanks very much for having me.